Welcome to SkyTech-Nexus. The summer of 2025 was expected to be yet another chapter of relentless growth for Tesla in China, a market that had fueled much of the company's global momentum. Investors and analysts alike anticipated record-breaking sales with the Shanghai Gigafactory running at full capacity and new models poised to capture even more market share. Instead, what unfolded was a sudden and dramatic slowdown that caught nearly everyone off guard. The Shanghai Gigafactory, once a symbol of Tesla's unstoppable rise, saw its production lines slow to a crawl. Domestic deliveries plummeted, reaching their lowest point in a year and a half, leaving executives scrambling for answers. By July, the numbers told a sobering story. Tesla's market share in China slipped from 16.5% to just 13%. This wasn't just a minor dip, it was a clear signal that Chinese consumers were turning away, drawn instead to a growing field of domestic competitors offering innovative features and aggressive pricing. The company's once ambitious goal of selling 900,000 vehicles in China now looked increasingly out of reach. Internal projections were hastily revised downward, with estimates falling to around 820,000 vehicles for the year. The mood inside Tesla's China offices shifted from optimism to concern. This shortfall didn't just impact China, it sent shockwaves through Tesla's global operations. The company's worldwide delivery targets, once set at an ambitious 2 million vehicles, now faced a potential downward revision to 1.8 million. The ripple effect was felt in every corner of the organization. For a company built on the promise of exponential growth and constant innovation, this was more than a setback. It was a wake-up call. The challenges in China forced Tesla to confront uncomfortable questions about its strategy and adaptability. The speed and severity of the downturn shocked even Elon Musk. For years he had believed that Tesla's brand power and technological edge would guarantee success in any market. But the events of this summer challenged that belief in a very real way. The summer of 2025 proved that no company, not even Tesla, was immune to the fierce realities of the Chinese market. Local competitors were innovating rapidly, and consumer preferences were shifting faster than ever before. The silence in the order queue was a clear message: old strategies were no longer enough. For Tesla, the road ahead in China would demand new thinking, fresh ideas, and a willingness to adapt to a market that was changing at breakneck speed. Tesla's troubles in China were the result of a triple squeeze. A convergence of challenges that threatened to upend the company's ambitions in the world's largest electric vehicle market. These were three converging pressures, each intensifying the other, and together they threatened Tesla's entire strategy in China. First, a brutal price war erupted, slashing profit margins across the industry and forcing Tesla to make tough decisions. In April, Tesla cut Model 3 and Model Y prices by up to 5% in a bid to spark demand. But the hoped-for sales surge never materialized. Instead, the market remained stubbornly flat, and the price cuts only deepened the margin squeeze. Second, local competitors like BYD surged ahead, leveraging rapid innovation and aggressive pricing. BYD's Blade battery, a breakthrough in both safety and cost, allowed them to undercut Tesla and rapidly expand their market share. BYD's structural battery design gave it a cost edge Tesla couldn't match, and its sales soared while Tesla's stagnated. The competition was no longer just about technology, it was about survival in a fiercely contested market. Third, the cost of raw materials rebounded sharply. Prices for lithium, nickel, and cobalt, all essential for EV batteries, rose again, squeezing Tesla's profits even further and making every vehicle sold less lucrative. The result was a perfect storm. Tesla found itself caught between falling prices and rising costs, with its gross margin dropping sharply in the first half of 2025. The financial pressure was relentless. The Shanghai operation, once Tesla's crown jewel and a symbol of its global ambitions, now faced a fundamental threat to its profitability and long-term future in China. The triple squeeze wasn't just a temporary setback. It was a clear warning that Tesla's China playbook needed a complete overhaul. The company would have to rethink its approach if it wanted to survive and thrive. The perfect storm had arrived, and Tesla's future in China was suddenly more uncertain than ever before. In 2025, BYD, Tesla's fiercest rival and China's homegrown electric vehicle giant, completely rewrote the rules of the EV game. While Tesla had long been seen as the global leader, BYD's bold moves would soon force the entire industry to rethink its playbook. In May, BYD ignited a massive price war, slashing prices on 22 of its models by up to 30%. This wasn't just a marketing gimmick, it was a calculated strike that sent shockwaves through the market, making electric vehicles more accessible than ever for millions of Chinese families. The Seagull EV, already a runaway bestseller, saw its price drop to just 55,800 yuan, about $7,750. This move didn't just undercut competitors, it reset global expectations for what an affordable, high-quality EV could be, and made headlines around the world. BYD's secret weapon was its deep vertical integration. By controlling everything from battery production to final assembly, BYD could absorb these aggressive price cuts and still post a 20% gross margin, outpacing Tesla's 16% and leaving rivals scrambling to keep up. The strategy worked brilliantly. BYD's sales exploded, as Chinese buyers flocked to showrooms for a range of feature-rich affordable vehicles. For many, BYD made the dream of owning an EV a reality for the first time. Tesla's response, modest price cuts and a premium-only lineup, looked timid by comparison. With fewer affordable options, Tesla found itself exposed in a market that was rapidly shifting toward value and variety. But BYD's ambitions didn't stop at China's borders. In April, it outsold Tesla in Europe for the first time, and prepared to launch the Dolphin Surf at a price far below Tesla's cheapest model, signaling a new era of global competition. BYD's playbook was clear: dominate China with unbeatable prices, then use that scale and efficiency to conquer global markets from Europe to South America and beyond. For Tesla, the message was unmistakable. The era of easy dominance was over. The competition was fiercer, faster, and more innovative than ever before. The rules had changed, and BYD was now the company writing them, setting the pace for the future of electric vehicles worldwide. Tesla fought back with a flurry of moves, but each came with trade-offs. Price cuts in April aimed to keep Tesla in the game but did little to reignite demand. Inside the factory, Tesla accelerated its shift to LFP batteries, hoping to cut costs and reduce reliance on expensive metals. Shanghai pivoted to become a major export hub, sending more cars to Europe, the Middle East, and beyond to offset weak Chinese demand. This kept the factory busy, but exports brought lower margins due to tariffs and shipping costs. Tesla also pushed its full self-driving software as a subscription in China, seeking high-margin recurring revenue. But Chinese drivers were skeptical, and adoption rates remained low. Each move bought time, but none solved the core problem. Tesla was losing ground in its most important market. Tesla's countermeasures proved to be stopgaps, not solutions. Price cuts eroded margins, turning a premium product into a commodity and forcing Tesla to chase volume in a shrinking market. Exporting from Shanghai kept production up, but European tariffs slashed profits, making this a temporary fix at best. The push for software revenue fizzled, as local brands offered advanced driver assist features at lower prices or even for free. Tesla's efforts addressed symptoms, not the root cause, a mismatch between its offerings and what Chinese consumers wanted. The market demanded affordability and variety, areas where Tesla lagged behind. Without a fundamental shift, Tesla's China strategy was running out of road. External pressures piled on, compounding Tesla's woes. New industrial electricity tariffs in China raised production costs, especially for energy-hungry processes like battery manufacturing. A weakening yuan meant Chinese sales translated into fewer US dollars, hurting Tesla's reported earnings. Stricter environmental regulations forced costly upgrades to Tesla's Shanghai plant, diverting capital from innovation and price cuts. These rising costs, energy, compliance, currency, chipped away at margins, making it even harder to compete on price. Meanwhile, BYD's vertical integration let it keep costs low and stay nimble. For Tesla, every new regulation or expense was another blow in an already uphill battle. The external environment was relentless, and largely out of Tesla's control. Tesla's biggest weakness was self-inflicted, a glaring hole in its product lineup. As Chinese buyers flocked to affordable B-segment sedans and crossovers, Tesla had nothing to offer. The Model 3 and Model Y were too expensive for the mainstream market, leaving millions of buyers to rivals like BYD. BYD's Seagull and Song models became runaway hits, offering modern tech at prices Tesla couldn't match. Tesla's long-promised entry-level Model 2 remained vaporware, with production years away and no clear timeline for China. The delay was a critical misstep. By the time Tesla arrives, local brands will have cemented their dominance. Tesla was left fighting for a shrinking premium niche while the real battle for market share raged below. The absence from the mass market wasn't just a missed opportunity, it was a strategic blunder. Competitors exploited it mercilessly. Geopolitics further boxed Tesla in. US-made Teslas faced steep tariffs in China while Shanghai-built cars couldn't access US subsidies, siloing production and limiting flexibility. Factories were forced to serve specific regions, preventing Tesla from optimizing its global footprint. Even China's government, once welcoming, began warning of destructive price wars and overcapacity, signaling a tougher regulatory climate ahead. Meanwhile, a strong US dollar and weak Chinese consumer confidence dampened demand on both sides of the Pacific. Tesla was caught in a fractured world, navigating trade barriers, shifting regulations, and economic headwinds. The company was no longer just selling cars, it was playing geopolitical chess. Every move carried new risks. The events of 2025 forced Tesla to confront a hard truth. Its old playbook no longer worked in China. The triple squeeze of competition, costs, and a product gap shattered the illusion of effortless dominance. Incremental tweaks weren't enough. A fundamental rethink was needed. Without a competitive, affordable mass-market car, Tesla would remain a niche player, vulnerable to local giants like BYD. Accelerating the entry-level model was urgent. Waiting meant seeding the market for good. Tesla also had to localize its offerings, adapt features and pricing, and partner with Chinese tech leaders to stay relevant. The question now, how can Tesla deliver unique value in a market flooded with innovative, affordable alternatives? Without bold change, Tesla's future in China will only grow dimmer. Subscribe the channel now. Thanks.